back in January of 2008, I came on CNN on Wolf Blitzer, and I made a complete idiot of myself saying that Lehman Brothers was going down. Now, Wolf and CNN did not like that show. Plus, they had a Wall Street person who was trying to defend Wall Street, those criminals. But anyway, so in January of 2008, I warned that Lehman was coming down. In September, I believe, Lehman came down, and that was the beginning of one of the biggest crashes in world history. This next crash coming is going to make 2008 look like a blip, like nothing, because this is about pensions and it's a global crisis.
Robert Kiyosaki, also known as Rich Dad, has been sounding the alarm of the impending pensions crisis lately, and he is totally right to do so. Across most of the developed world, where pension markets have grown in size and complexity, the future retirement of millions of people is potentially compromised. Some news outlets are already starting to cover this unfolding crisis. For example, the British newspaper The Telegraph recently reported that retirement crisis looms as state pensions fall £315 a month short, and the Epoch Times, writing about Americans, stressed in September of this year that inflation, stock market meltdown force more retirees to unretire. How can this be? Well, the answer is not that simple, but it has to do with the type of pensions that were initially rolled out, with the number of people that were estimated to be alive in the years to come, and, of course, with their expected lifespans. The first major type of pensions to be rolled out across the developed world were the defined benefits, or DB schemes. These are usually workplace pensions arranged by the employer. They're sometimes called final salary or career average pension schemes. According to the definition laid out by the UK government, workplace schemes are usually based on a number of things. For example, your salary and how long you've worked for your employer. The pension provider will promise to give you a certain amount each year when you retire. This last bit is important. The pension provider promises to deliver retirement income. In other words, DB pensions guarantee a pension. However, as populations grew in size and the longevity of life expanded, the demand for retirement income exceeded the ability of DB pension funds to deliver it. Tom Siddell, former attorney at the U.S. Securities and Exchange Commission, SEC, the body that regulates most of the U.S. financial markets and which sets the tone for public investments worldwide, had to say this about how some large U.S. pension funds are trying to deal with the fact that they are facing a ticking time bomb.
So what I did in the investigation in Rhode Island in 2013 was to show that Gina Raimondo had loaded up the pension fund on very secretive hedge fund and private equity investments. So she ushered in an era of secrecy. Public pensions in Rhode Island and around the country had never been secret in the past. They're supposed to be the most transparent of all pensions in the world, and their state Freedom of Information Act laws in every state, they're supposed to ensure that. Well, she came in and said all of the investment contracts, all the investment dealings for the Rhode Island pension fund will henceforth be secret. And so what she was doing was gambling big on hedge funds, and I said in 2013, this is going to end very badly. And within a few years, she racked up losses of nearly $1 billion. This is an $8 billion pension fund. So how does an $8 billion pension fund earn back that billion that she lost? Well, there's only one way to get it back, and that's really to go to the taxpayers.
As Siddell pointed out, the Rhode Island pension fund was $8 billion, which is not much by pension standards. CalPERS, however, is a $469 billion fund. It is the largest government pension in the United States, which used to be known as the best-run pension in the U.S., but recently it has been faced with scandal and controversy. CalPERS underperformed for a decade. The fund performed worse on average than other large U.S. public pension systems over the last decade, missing out on billions of dollars in potential earnings. Chief Investment Officer Nicole Masico told the system's Board of Administration this week. This means that CalPERS, as well as other pension funds, will seek returns in riskier parts of the markets, like private credit, venture capital, and hedge funds. Remember, these are hard-earned savings of people who worked a lifetime, which are not placed in riskier and riskier products. This is one response to the issue of more people who are living longer. Another is to transition to a defined contribution or DC scheme, which, unlike the DB pension plan, does not promise any income during retirement, as the pension payments in a DC scheme depend fully on how markets perform. In recent years, DC plans have been growing in many rich countries, known as P7. But this strategy of relying too much on markets to deliver for pensioners is not a bulletproof solution. As legendary investor George Soros pointed out more than 20 years ago, financial markets are irrational and volatile.
Markets are, financial markets are inherently unstable. It's part of the system. And this goes contrary to the received wisdom of economic theory, which talks about equilibrium. Right now, everybody talks about imposing market discipline, as if that would take care of everything. I think you need to have an additional discipline, because if markets are inherently unstable, imposing market discipline, you are imposing instability. And how much instability can you live with? So you have to introduce this additional principle. Maintaining stability has to be an objective of public policy.
This was Soros in 1998. The same principles hold true today. Financial markets are unstable, perhaps more so than ever after more than a decade of central bank policies that distorted asset pricing. Soros was calling for government intervention to deal with markets' instability, but the government cannot do anything to prevent it. It is the central bank that sets the tone for how markets move and, ultimately, how funds like pension schemes perform. However, there seems to be a potential solution to this. Maybe it is risky, maybe it is unconventional, but it is an idea. Crypto.
Now, if you said the future expected return from a cryptocurrency over the next 30 years is 0 or 1 million, and we're at, let's use Bitcoin as the example, we're at about 8,000, 7,500. Well then, as a millennial, you're basically faced with the same fact set that you had in equities back in 1982, or in bonds back in 82. Was inflation going to be there forever? Or was the 18% returns you were given in bonds exceptional? Was the PE of 6, meaning the cult of equity was dead? Or was there a long-term opportunity in America and the global economy to revive itself? I think crypto is here to stay. The blockchain development will come.
Bitcoin has gone higher and higher, not without validity, but recently it hovered at about $19,000. Some pension funds may already be trying to get into crypto. Research company Morningstar recently wrote a piece of analysis that pointed out some considerations for this move. Legal matters. Is crypto regulated? Prudential risks. Is it rational to gamble with the money of retirees? And genuine investment considerations. Is crypto helping the portfolio or not? The Virginia Pension Fund already dived into the cryptocurrency universe, seeking higher returns in order to deliver retirement income. The crisis is getting traction. The Financial Times reported on this, stating that a $6.8 billion Virginia pension fund is looking to boost its return by investing in crypto lending markets, despite a crisis in the sector that has pushed several companies into bankruptcy and left retail investors with heavy losses. The Fairfax County Retirement Systems recently gained approval from its board of trustees to begin investing in yield farming, in which investors lend out their digital tokens to crypto projects in return for a fixed stream of payments. Are pension funds getting desperate? Do you think we are heading towards a retirement crisis, as many economists and investors are predicting? Let us know in the comments below how you are planning for your retirement years. If you liked this video, click the like and subscribe button for more content. Thank you for watching, and we will see you next time.